David Lenigas, Chairman of UK Oil and Gas and various other little companies, or growing companies.
Yeah, as a consumer and as a producer, and reading as much as I can, and with my guys reading as much as we can, and speaking to sort of some of my fund manager mates in the States, it can only stay so low for so long. I mean, what people don't understand is to maintain world current oil production requires a massive amount of annual reinvestment. Everyone stopped, except for Lenigas and oil, which continues this year. But if you look at the headlines, Shell's just canned a $6.2 billion project. The headlines a week and a half ago, $970 billion worth of project Shell for 2015. China now importing record amounts of oil. Last month, 7 million barrels, and China's saying they're happy to take every ship on the sea that's got oil in it to build up their strategic reserves. If you look at the cost base, and everyone goes and looks at the Saudis, and I saw the Minister of Oil this morning, or last night in Saudi Arabia, saying that they've got enough cash reserves in Saudi Arabia to weather a low oil price for 8 years. But when you look at where a lot of the world oil comes from, forget about OPEC or whatever, but you're looking at Saudi Arabia is the lowest cost producer at $5, but it's not owned by the Saudi government. It's owned by the royal family. So that royal family puts money into what is one of the fastest growing economies in the Middle East to fund a burgeoning population growth of quite multifaceted religious partnerships within Saudi Arabia, and they can last for 8 years. Now I'm pretty sure the Saudis don't want to wake up in 8 years and find they have no cash reserves. If you look at Kuwait, the argument is Saudi and Kuwait from the OPEC side can wear a low oil price better than most, but Kuwait is going to run out of cash reserves quite quickly. If you look at the African economies that are large producers, Nigeria's in trouble. They need $100 to balance their budget. If you look at Angola, they need $100 to balance their budget. You're going to start seeing social anarchy in some of those sorts of countries because they're not supplying what people really require, which is hospitals, education, public service sector support, all those sorts of issues. And then you look at what's happening in America. And I went to New York about a year ago with some very, very big private family office guys for about 2 days. And I watched a guy present on his views on the oil price and oil supply. And he said that in about a year's time, maybe 2 years' time, America will be self-sufficient with oil and will be, in fact, a net exporter of oil. And he's pretty right. What's fundamentally changed? America's producing an extra 1.5 million barrels a day. Okay, everyone's blaming fracking. Fracking is an interesting way of America increasing their overall oil production. But what's fundamentally changed in America is economies, miles per gallon. If you look at America, 62–70% of America's power is generated from coal and gas. Most of America's oil goes into transport sectors. 10 years ago, what was the average mile per gallon per car in America? 16, 17. With legislative changes, you're now talking 25, 26 miles per gallon. Now, bearing in mind, everyone in America wants to get in their Winnebago and drive, or their truck or their SUV and drive. Right? There's now movement at foot to get the average fuel economy of an American truck and automobile into the 30 mile per gallon. Now, when you're looking at 4.5, 5, 6 million barrels a day, that stretches longer. Trains are becoming more efficient, cars are becoming more efficient, aeroplanes are becoming more efficient. It means that America doesn't need to suck in all that oil because the world's getting more efficient. And that's what's also happening. Forget about America, that's happening in the rest of the world as well. Everybody wants a greener car, right? The price of oil went up. everyone started buying Priuses, everyone started buying electric cars. Now the price of oil's gone down. General Motors has just had the biggest half year they've ever had in their life. You know, everyone's going, quick, let's go buy a truck.
Yeah, but just, I mean, you've got the rationalisation for oil turning around from these levels, but isn't it the case that oil in the last year has made a monkey out of everyone? I mean, there's people who are...
No, politics, you're right. Politics has made a monkey out of everybody. The fundamentals haven't changed. The world still consumes 2 barrels of oil for every barrel found. Fact. Yeah, it's a finite resource. What's happening is you're getting artificial dumping of oil on the marketplace, and there's been some strategic changes, particularly with banks like BNP, which were the largest lenders for bunkering of oil. They're out of the market. So there's a huge amount in bunkering, which meant that there was a lot of surplus supply on the marketplace. Politics is what's made a monkey out of people with predicting the oil price. But the fundamentals say that the oil price has to go up because supply and demand will swing the other way. You know, America's strategic reserves are high. They've got room for another 100 million barrels of strategic reserves. China's got room for another 100 million barrels of strategic reserves. The Baltic Index went up 4-fold in the last month because China said, send all the super tankers to me. Yeah, it doesn't take long for the people with the 100-year strategy to soak up the free-flowing oil. And then you look at what's happening in America. Okay, America's oil production was up 60,000 barrels a day last month. And they reckon it will continue rising for the next 6 months. Fine. That's the fracking effect coming in. And the fact, not just fracking, but conventional oil as well, is that people have invested a bucket load of money into drilling new wells and they're now coming to production. But look at Russia. You know, Russia is a very, very expensive place to maintain their level of, you know, where they sit in the pecking order with oil supply on an annual basis. You know, try and go and drill a new well in Russia today. Look at what happened to the rig count the other day in America. It was one of the steepest drop-off in rig counts in the last week alone in America in something like 2 decades. Yeah, you're going to see that reinvestment stop. The banks are reluctant to lend, and yeah, unless you're BP or ExxonMobil with a huge balance sheet and huge amounts of cash at bank, you still rely on the banks. Find me a bank manager that's going to go, yeah, Zach, you're a really cool dude, I'm going to lend you 20 million this week. He's not going to lose his job for you. They're going to wait and see what happens at the bottom. So the world needs hundreds and hundreds and hundreds of billions of dollars of reinvestment to keep this oil production up. It stopped.
Okay, well that's oil, and you're basically saying we're approaching, we're at low levels. Let's say
I think you're bouncing around the bottom. I think there might be a little bit more politics to see how low they can get it to go. But but this isn't all just about physical supply and demand. I mean, this is also about hedge funds shorting. So
there's a sort of boomerang. I mean, the price overshoots on the upside.
Yeah, there's so much. You see, we all look at physical. Right, I'm going to sell you a barrel of oil backwards and forwards. The derivative trades on oils far outstrip the physical trades on oil. And who's one of the biggest oil derivative traders in the world? The Saudis. Because they can cover the margin call with physical if they get called. They probably took a huge short position at $100, and at some point they'll cover the short because they can, and they'll make a fortune on the way up again as well.
Well, they're lucky Saudis. But I mean, I remember you said you were a geologist.
I'm a mining engineer.
Right. You studied at the Kalgoorlie School of Mines.
Yeah.
And so you probably have 20 years of knowledge, of sort of first-hand knowledge of all of this, of mining commodities moving up and down.
Yeah.
Isn't it easier to actually make a call on these commodities via companies which are investing in them, or based on them, rather than the commodities themselves?
No, it's about sentiment. Well, you read the newspaper every morning. This is a global tragedy. The oil price is falling. Everyone's getting a tax cut every time you fill up. Your missus has got an extra 10, 15, 20, 30 quid every week. They fill that goddamn car up. It's a tax cut. It's one of the greatest political successes for the world. I can't understand the media. This is a tragedy. Guess what? When the oil price is low is when the oil service companies and the oil companies go and slash staff. It's their one opportunity to walk in and say, to a room like this, right? Let's just say I'm XYZ Oil Inc., right? You're a really nice guy. I'll tell you what, 3 people, I wanted to get rid of you ages ago. So you call them all in and say, the oil price is stuffed, 10% of you out of work. Now what have I done? I've just trimmed my overheads. And you can see it, Halliburton, Schlumberger, they're all cutting costs, they're all trimming the fat off their organisations. And you're going to see it sort of rebound. So
it's a good time to explore. You know, you can just
no,
say,
but you can't explore because the banks won't give you money unless you've got the money in the bank. And most pubcos don't sit there with a huge slush fund because shareholders hate you raising money just for the heck of raising money. So most companies don't sit there with a slush fund of money.
Shareholders are like bank managers. When it's time to raise money, they don't want to say yes, and when it's time probably not to raise money, they'll hand over the cash.
Yeah.
Opposite to the cycle.
Yeah, but that is the cycle for bank managers.
And shareholders.
Yeah, that's a fact of life. But that's the time you go buying.
And,
yeah. I'm buying. I like.
How do you approach? I mean, you know, we're here now, beginning of 2015. How are you approaching this situation where most people are crying about the state of the oil price?
Well, look, I mean, look, let's talk about it on a personal level with some of the companies I run. Okay, what we did, you know, and I copped a lot of grief before the end of the year. Lenigas is raising money. Lenigas is raising money. You know, as a board, we could sort of smell it. So what we finished last year with money in the bank. We did some financings. We got some more money in the bank because there were opportunities to look at cleaning up some quite distressed situations, whether they're your partners, whether they're things you've been looking at for a while. And I tell you what, I mean, I'm looking at deals right now where I've got some partners who just want out. Yeah, and I play the longer game. I've got cash. I don't want to spend much. But I tell you what, I got more than you got, so I tell you what, would you like a little bit, and you go and do your other thing in life. Because a lot of these oil concessions have commitments and costs. And, you know, the market's affected most of these companies to the point that they can't even carry their commitments. So, you know, when you've got commitments on your balance sheet that are negative, you know, you're now, as a board, becoming into, you know, do I want to be into the possibility of, am I technically insolvent because of my liabilities on my balance sheet to the government? So there's a lot of opportunities there. You know, we're busy every day just looking at opportunities.
Is there a time that you can remember like this before where you bought at the bottom and...
2008. I mean, people forget, 2008, the oil price was $143. In 4.5 months, it went to $30. Like that. And, you know, what was the crisis then? The financial crisis. Banks.
It was the peak oil. It was the peak oil rally.
No, but everyone was calling it $200. A lot of things changed with the financial crisis. Yeah? A lot of people got richer. A lot of people, more people got poorer. A lot of people didn't own their houses at the end of it. But you know, within 3 months, the oil price went to $30 because there was a financial crisis, and within 3 months, it was back up to $70 to $80. Yeah, we're at this 100 and I mean, we're talking Brent, right? $115, we're down to 50. Will it go a bit more? I think the hedge funds will try and push it a bit more. I don't think oil producers are pushing it up or down. I think it's hedge fund driven. I mean, I spoke to a couple of my mates in New York last week and the week before, and they're all going, we're starting to cover our short positions. We're buying as long a dated warrants as we can and option positions out to March 2017. We just see this as a recipe for making money. But they weren't going to start doing that until oil sort of got into the $47, $46, $45 range. And that's why I think you're seeing it bounce. And that's why I made a call last week. I think we're sort of starting to hit the bottom because you get that power of money. I mean, I don't know what the formula is, but the amount of derivative trading on oil versus physical is something like a factor of 8-fold. It's cyberspace money. Yeah, so...
Right, just going on from oil to gold and the metals area. How do you see that this year panning out? Because obviously gold is really precious metals. The gold chart looks fantastic. Silver looks fantastic.
Yeah, but gold's on different fundamentals. I mean, gold is typically volatile up or down depending on the concept of generally what's been with respect to political insecurity, Switzerland, where do you want your money, all that sort of stuff. If there's a crisis, go stick your money into gold. Okay, we've got all the issues with IS, we've got, you know, Crimea, Ukraine, etc., 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 etc. Switzerland was the thing that popped gold $100. The interesting thing is the dichotomy between resource companies and the oil price. And I sit there scratching my head. I mean, one of the biggest cost components for a mining operation in the world is the price of energy. Completely different to airlines. Airlines are doing this. Resource companies are going that. And one of their biggest cost contributors to, you know, how profitable or not is your operation is fuel. The oil price has fallen off a cliff. You know, the resource companies are making money, but the problem they've got is they're going, oh, but the copper's now at, you know, low prices, zinc's down, everything's down. We're at a now. I mean, I remember when we were all talking about the super cycle for commodities of 10-year super cycle. Normally you're in a 7-year cycle. And then there was the 10-year super cycle. I mean, if you look at it, we're now in a 12.5-year super down. I mean, commodities are at a 12.5-year low, and your unit cost of one of your biggest contributors of costs is actually halved in months.
But do you have an answer to the idea that, which is the sort of fashion of the moment, that we're into sort of an extended deflation, which is why oil's falling and eventually gold?
Yeah, but if you look at deflation, okay, take out the oil price, which is actually a tax cut for everybody. We're not in deflation. It's the way these governments calculate inflation or deflation. If you take out the effect of oil price on inflationary numbers or deflation, the world's actually growing plus. But because the oil price has fallen, oh no, we're going to deflation. Good for people with mortgages. It's fantastic. I got a mortgage. Got two. It's good for mortgages. It's good for security of family, because you know you're not going to be waking up one morning and you know you've got another $150 or $800 a month extra mortgages. You know, you got more money. I mean, I think the press have got a lot to answer for, because I don't think they're getting it right. I think the oil price going down is a world tax cut. How many governments in the world subsidise oil for their population? Now they're subsidising less, which means they can put more into healthcare, education, etc., etc. So I mean, it's a weird world we live in.
As you as a deal maker, which is the latest thing I've read about you, is this the
That's
best,
what you say about it.
Is this the best time that you've had?
This is the best time to go and buy really, really undervalued assets that people have spent a lot of money on that just can't afford to keep. Yeah.
And of what you're doing at the moment, what would you say is the sort of the something which has the best long-term outlook from this point?
Oil with near-term production.
So
Oil or gas with near-term production,
right.
Because the banks aren't funding it. And you know what? I don't want to go and buy a $100 million deal. Leave that to the bigger guys. There's plenty of nice little $1, $2, $3 million deals that create companies in time. Look at Lenigas and oil. Everyone bagged me when I did a financing in LGO at 0.4 of a penny to buy Goudron. You know, it was producing. You know, we bought it. It's now producing a lot. Neil's off to Trinidad. LGO still makes money. And what's Neil going over for? And as he said to me yesterday as he headed off, he said, Dave, there's going to be so many situations in Trinidad for me to have a look at, because I'm cash flow strong, my balance sheet strong, and most of my compatriots in the oil and gas sector are falling off perches. He's really looking forward, and we're doing the same with little companies like UCOC, and there's some wonderful little opportunities. So, but you know, it ain't over till the ink's dry on a piece of paper.
I just said, you said just before we started that you wanted to talk a bit about rare earth minerals, because that's your sort of your pet.
No, some of you people said you wanted to talk about rare earth minerals.
We won't talk about it then. But
I'm happy to, but don't ask me any insider questions. You all want to know who was the big UK fund manager that decided he'd like to own 4.6% of REM. You're going to have to wait. I know that's one of the biggest questions that people are asking.
And how long do we have to wait?
Well, I mean, if you read the news release, the shares get issued 22nd. They actually don't own them till the 22nd.
Oh, okay.
And then I think the rules are they've got 3 days to report their TR1 form.
Okay.
But they're big.
How long?
And they're a pension fund. And yeah, and I'm glad Gervais, I haven't seen Gervais for a long time, and Gervais and I have sort of done some deals way back. And I've had a bit of a beef in my life about fund managers, especially hedge funds, because I think their motives are different to what pension funds are. And when a pension fund comes and sees you and says, I want to invest in rare earth minerals, when you look at what you're doing in Mexico and what's happening in Yangibana in Australia, and they're both multi-billion-dollar projects, pound for pound, this is something I'd really like to have a good go at. And this is really the only way I can do it. What are you going to do, say no? The world's in meltdown.
I would have thought you'd have many people knocking on your door.
It's hard. See, the problem with fund managers, and I know Gervais will probably talk about his own situation, and the world's changed to pre-2008. In 2008, there were a lot of 30, 40, 50 million, $100 million funds around. A couple of young guys running it. It's the way it worked. They can buy micro-cap, micro-cap, long, short, levered, whatever. And then what happened in 2008, a lot of the small cap funds just disappeared. So if you look at the big cap funds, I mean, you go to New York, right? New York, micro cap is $500 million market cap. There are very few that will play under that, and it goes into these little special sits funds that they hate having you, but they've got to sort of do it anyway. But look what happened here in London, Hugo Tudor, BlackRock. He was a great funder of small resource companies. Evie Hambro, I think he's still doing it. Mark Denning from Capital. They were banned from trading any. I mean, I remember Hugo, I can't trade anything unless it's got a market cap of $1 billion. Sorry, I've got to sell my Lonro shares. Sorry. And you haven't seen the spot fires start up with all the little 50 million, 20 million funds start up yet. So that's the biggest problem you get with getting a fund. And now when a fund manager comes in and sees me and says, I really like this, I'd like to have circa nearly 5% of you, go, done. Now to me, that's a very interesting sign that fund managers are talking small co's. But from what I sort of understand at the moment is you might get some fund managers interested at circa $100 million market cap. Until you're $250 to $500 million, your global audience from fund managers is maybe a couple of %. And that's the problem. And I don't see that changing for a while.
Okay, well, I think we'll leave it there. David, thanks for speaking with us tonight, and hopefully when something else exciting happenings in your world, you'll come around again and give us some more insight. Thank you very much.
Pleasure.